Hmm. Well, folks, good afternoon. How are you? Do a quick little commentary video, let you know what I'm focusing on for this coming week. Waiting to hear my audio come back to me. I'm listening to headphones, so I'm not going to. Okay, I can hear myself now. Okay. All right, so welcome. Hope you're having a wonderful weekend. And we're starting off here with the indices. I'm going to run through these as a broad brush view. Then we'll do an individual daily, and then we'll drop down to a 15-minute time frame, and then I'll go into crude oil, gold, silver, and I'll look at dollar, euro dollar, and pound dollar. And that'll be it for today, okay? I'm not going to go a whole lot in terms of commentary. I'm just going to give you what I think is the likely draw, and that'll be sufficient enough. And then we'll resume on Monday once we have some price action behind us. So right away we have the daily chart, and this chart here is the Nasdaq, and I am plotting them on a line basis on the close. I'm sorry, on the high rather. Usually when you click a line chart, its default is the close setting. And what do I mean by that? Let's go over here and highlight this, go to the little thing here. This is the settings I have set, okay? So when I'm doing comparative analysis or relative strength analysis between correlated market, I'm plotting them on a line basis. And if I'm comparing their highs, I want to plot all of them on a line basis on the high, okay? If I'm looking for bullish scenarios, I would reverse this. I would plot it on the low. Okay, so since they've been going up, we have everything going on over in the Middle East. I'm looking for some measure of retracement lower, and we're entering into that springtime where usually there's a tendency. It doesn't mean it's going to happen all the time. Just usually there's a tendency for the market to try to draw down a little while, and I'm looking for that scenario. We have two forms of SMT divergence. So NASDAQ, you can see I used this high here in October, the end of October, the first week of November, and you can see that they're closely associated with the same time. And NASDAQ, we just recently came up to it here on the end of January, but failed to get above this high here in the ES. So this is the S&P pound dollar. And that'll be it for today, okay? I'm not going to go a whole lot in terms of commentary. I'm just going to give you what I think is the likely draw. Well, folks, good afternoon. How are you? Do a quick little commentary video, let you know what I'm focusing on for this coming week. Waiting to hear my audio come back to me. I'm listening to headphones, so I'm not going to. Okay, I can hear myself now. Okay. All right, so welcome. Hope you're having a wonderful weekend. And we're starting off here with the indices. I'm going to run through these as a broad brush view. Then we'll do an individual daily, and then we'll drop down to a 15-minute time frame, and then I'll go into crude oil, gold, silver, and I'll look at dollar, euro dollar, and pound dollar. In the Middle East, I'm looking for some measure of retracement lower, and we're entering into that spring time. Folks, good afternoon. How are you? Do a quick little commentary video, let you know what I'm focusing on for this coming week. I'm waiting to hear my audio come back to me. I'm listening to the headphones, so I'm not going to. Okay, I can hear myself now. Okay. All right, so welcome. Hope you're having a wonderful weekend. And we're starting off here with the indices. On the high. Okay. If I'm looking for a quick little commentary video, let you know what I'm focusing on for this coming week. I'm waiting to hear my audio come back to me. I'm listening to the headphones, so I'm not going to. Okay, I can hear myself now. Okay. All right, so welcome. Hope you're having a wonderful weekend. And we're starting off here with the indices. I'm going to run through these as a broad brush view. Then we'll do an individual daily, and then we'll drop down to a 15-minute time frame, and then I'll go into crude oil, gold, silver, and I'll look at dollar, euro dollar, and pound dollar. And that'll be it for today, okay? I'm not going to go a whole lot in terms of commentary. I'm just going to give you what I think is the likely draw, and that'll be sufficient enough. And then we'll resume on Monday once we have some price action behind us. So right away we have the daily chart, and this chart here is the NASDAQ, and I am plotting them on a line basis on the close. I'm sorry, on the high rather. Usually when you click a line chart, its default is the close setting. And what do I mean by that? Let's go over here and highlight this, go to the little thing here. This is the settings I have set, okay? So when I'm doing comparative analysis or relative strength analysis between correlated market, I'm plotting them on a line basis. And if I'm comparing their highs, I want to plot all of them on a line basis on the high, okay? If I'm looking for bullish scenarios, I would reverse this. I would plot it on the low, okay? So since they've been going up, we have everything going on over in the Middle East. I'm looking for some measure of retracement lower, and we're entering into that springtime where usually there's a tendency. It doesn't mean it's going to happen all the time. Just usually there's a tendency for the market to try to draw down a little while, and I'm looking for that scenario. We have two forms of SMT divergence. So NASDAQ, you can see I used this high here in October, the end of October, the first week of November. And you can see that they're closely associated with the same time. And NASDAQ, we just recently came up to it here on the end of January, but failed to get above this high here in the ES. So this is the S&P. It was able to go higher. And Dow obviously was able to go higher because it's unruly and it's only three individual companies that make up that index. So it's a little bit more squirrely, a little bit more exaggerated. I include it here just for completeness sake. I'm really focusing on the divergence between the NASDAQ, the green, and the ES in blue. Okay, so you can clearly see that we failed to make a higher high while ES was in fact making higher highs. Then Dow was able to make another higher high here, while ES was saying, I'm not interested in seeing that. And the NASDAQ was absolutely not willing to participate either. Okay, so with that said, now we can roll into a little bit more of a discussion for the other indices. Hmm. So this is the daily chart for the Dow. And I like this area right in here. So springtime, first half of the year, this is where I'm expecting Dow to get to. There, so that's where I'm anticipating price to eventually get to that by June something, mid June maybe. It can obviously do that rather quickly if things start to really accelerate in the Middle East. We'll run into the ES. Okay, and if you've been a student of historic price action, I'm a little bit of a buff in that regard. The S&P 500 has made a very historic level of compression. In other words, the range in which it's slowly moved into a very narrow consolidation. We haven't seen these levels in a very, very, very long time. Okay, and to a degree that it was before I was even born, back decades, the last time we saw levels this low in terms of the range it's created. So we're looking at this in regards to the continuous contract. So I think what might be beneficial is if we do a comparison of the March contract. Okay, and I like these lows right here. Now, I don't suspect that we can get there right away before the close of this March contract. So, with that said, what I like to do is when we start getting close to an expiration month, like March contract expires in a week or so, we roll over and we start trading June contract. Okay, so the symbol for that would be M as in Michael. Okay, so I like to, about this time of the month when we have rollover, I start looking at both contracts, which is the nearby being March delivery, and then I look at the next contract, which is June, and I'm looking for disparities between what price is doing. I'm also looking for inefficiencies that may exist on the next month out, which is June contract right now, in relationship to the nearby, because the nearby is going to be the most traded, the higher interest, open interest rather, and volume. So that will build in by default more volume imbalances or common gaps in the next month out. So that next month out volume imbalance that may or may not be in price action for the March contract or the nearby, it will work towards giving me targets that would otherwise be obscure and not noticeable in the nearby contract, or in this case, March's contract. So in other words, just look at it like this. We have ES, so I have ESM for June contract 2026. Okay, and you can see how it gets real spotty over here. So it's not real helpful when we look at the next month out. So by having that also, one more time, go back to the March contract. You can see how that's nice and clean. You can see that. Now we'll also go back to do ES in the form of the continuous contract. That's this one here, okay? And you can see those exist as well. So by having that, it kind of gives us a framework for where the market may in fact draw to on a longer term macro time frame. And I say macro, don't confuse that with the 50 to 10, 20-minute delineations each hour where we're focusing on a draw to or a beginning of a move. That's not what I'm implying here. I'm talking about an overall general wide perspective because we're looking at daily charts. Okay, so I think this is where we're likely to draw to on ES for the first half of the year. We're just now getting into like the middle of March. So, and March is going to expire, and then we roll over into June contract. And the same thing, we'll look at the NASDAQ. So NASDAQ, we'll look at first the March contract. And similar lows, but I'm a little bit more excited about NASDAQ. I think they'll sell off more. And the reason why, because comparatively in relative strength relationships, NASDAQ was the unwilling indice to go higher, whereas Dow and S&P were able to go higher when we first opened up the stream here. NASDAQ has been unwilling to go higher. So there's a whole lot of distribution. That's my assumption. That's my perspective, that I think that there's a heavy distribution going on in these stocks. So therefore, any sell-off that's seen through the broad market, that means all indices, should be seen more aggressively and travel probably more in magnitude lower in the NASDAQ stocks than that of the blue chip companies in the S&P. Not to say that they can't have it as well, and not to say that the Dow can't tumble really far too. I'm just saying that it's better, and this is why I've been telling you all I'm bearish on NASDAQ. I've been focusing on this because of these macro tenets based on the unwillingness to go higher on NASDAQ. And because we can't go higher, because we've done enough by taking out these highs here, as I mentioned, trading at the inefficiency, then giving up the ghost, all these factors, you know, coalesce into a broader bearish market tone. And with all the things going on in the Middle East, it's just there isn't a whole lot of deep pockets of big money willing to take on risk right now. Okay, and we'll drop into the continuous contract. We'll move all that stuff. I know you're probably going, oh, you can go back and screenshot it, see what all that stuff was. I like these, yes, but I'm a little bit more excited about the likelihood of taking that out as well. So I like August's lows, basically, let's look at it that way, as the first half of the year draw on liquidity. If in fact we don't get there by June, I think we'll be there going into the fall months. In other words, that's where I ultimately think um, stocks are going to be heading. There's nothing bullish right now. No one wants to take on risk, and I think that we'll start seeing some events, let's say it that way, in the states that will be attributed to that, and it's going to foster fear, nervousness, skittishness on the part of the market. So all those narratives will come in play, and it'll be perfect justification for why the market's going to go down, because that's the reason why, not because there's all these factors here that we're looking at. All right, and then we'll look at NASDAQ from the perspective of the June contract. Okay, you can see how it's spotty. It doesn't help you to look at the next month out. So you have to have a common relationship between the time frame of the daily, between the nearby contract, the continuous contract, for a clear historical reference point. And then you have the wonderful aid of volume imbalances and inefficiencies that exist in this time frame while trading in nearby. In other words, whatever you can see in terms of inefficiency here or in the lower time frames, like 15-minute, 5-minute, those are going to be helpful to you because they may not exist in the March contract because this is June. So this is thinner. There's less order flow coming in and out of this particular contract versus all of the buying and selling that's going on in the March contract because it is the front month nearby. As we get closer to rollover date, that will diminish, and then more open interest and volume will be seen in the June contract. So there's this like little sweet spot where it affords you a little bit more visibility because of the thinner aspects of the next month that's going to become active and become the new front month. Right now, while it's next month out, all trading should be done on the March contract. But that March contract may be efficiently delivered in price, and the inefficiencies that exist on the June contract may be beneficial because those inefficiencies are to come in next month's delivery, but they may not materialize in the actual price action of March contract. So you can use the inefficiencies that form in June that may or may not be in March price action. And you'll see many times it's drawing to those levels that are really formed on this contract month than that of the actual front month March. All right, so I'm a NASDAQ kind of guy, so we'll start here. We'll drop into a 15-minute time frame, and we'll go back to this price action here. So right away we have sell side resting right here, and then we have sell side resting right there. So um, I'll try to be very quick about it because I don't want the videos to be all that long. And if you're watching and you can't see the, I guess the translation, give YouTube enough time. The last time I did a live stream, I think I went over by 2 minutes and it prevented it from happening. So I apologize. It was completely unintentional. My intention was actually to make sure that it was underneath 1 hour or 60 minutes. So that way YouTube can do whatever it does to create AI translations. All right. So 15-minute time frame. I won't be surprised, or I wouldn't be surprised rather, if we gap lower and come up and trade a little bit into the gap and then work towards these levels in here. I'm not bullish at all. I have no reason to anticipate bullishness. By some weird event that we open a little bit higher from where we closed, I would look for an open, overlap that opening range or that opening gap, new week opening gap, overlap that, and then treat the midpoint as kind of like the resistance point of that, not try to see it go above that and go lower. I would prefer to see it gapping lower, make an attempt to try to get into that gap, preferably um, fill it before we get into tomorrow's regular trading hours and be lower. That would fit the price action. It would fit the seasonal tendency. It would fit the underlying narrative. That would be perfect. It would be everything toggling off, checking off every box that would meet the criteria for a bearish market condition where nobody's really wanting to take on risk. And because no one's willing to take on risk, that means that we're bullish dollar. Okay, so it's a risk off scenario. Basically, that's what I'm looking at. So risk off is um, the likelihood of dollar eventually moving higher, and then other foreign currencies, which we'll look at, potentially moving lower. But the indices may actually lead that. So we may see this actually start to fall off, and it kind of like bolsters the idea of a firmer dollar index, and then therefore foreign currencies would weaken as a result of that. That's kind of like what I'm looking for. I'm looking for that segue of moving into that rotation across all the markets. And obviously, at 6 o'clock today, I'll have a better feel whether or not that's on par with what we see, because whatever we open up at will give me more insight. And I'll kind of like communicate that on X once we get to 6 o'clock. Give me like the first 15 minutes of trading, and then by 6:15 today Eastern time, I'll post whatever I think is either in line with what I say here today, or if there's an adjustment I need to make in terms of my expectations. This is not meant for you to take any trades off of it. It's just I'm just sharing, you know, paper trading commentary. Let's call it that way. Okay. So you're just watching it through the tape, and we'll leave it at that. So there's a small little gap there. If we did open up firmer, it would be interesting to see it utilize that. If we open up higher than that, which again, I don't expect it to do this, but if it were, I would expect it to trade lower and then treat that as a reclaimed bearish SIBI fair value gap, and then work towards going lower into these sell side liquidity pools. I know this looks real smooth up here, and all those ideas look romantic, but I'm gonna side with the idea that there's so much uncertainty, so much negativity, so much risk. Okay, there's real risk involved because of everything that's going on. in the Middle East and how it's spreading into other countries, and other countries are saying we're not going to back the U.S. investments anymore. We're going to probably pull our money out of that. A lot of the Middle Eastern countries are considering doing that. So that's all going to have a weight on these markets, and it's going to cause a ripple throughout all of them. And as technical analysts, okay, as a community, if we're looking at those considerations, obviously, large investment firms, um, big investors, they're going to be thinking about those things too, and they're not going to be in a hurry to get out here and assume that risk. There's nothing bullish right now, so we haven't entered a point of capitulation where one could say, well, you want to buy when there's maximum fear. Really, there isn't maximum fear yet. It's the beginning of those things coming in. So we haven't really seen a sell-off that would warrant the term capitulation, where the idea of maximum fear, then go in and start buying. That's when smart money would do it. Right now, we're still in consolidation with the unrealized move that goes out of that consolidation lower, which makes perfect sense right now. That's the beginning stages of what I'm anticipating. Okay, so it's kind of like hopefully making that more clear. And then we'll look at ES. Same thing here. Real close proximity, sell side liquidity pool. And we'll probably have to go out to the daily to pick up the next level in range. This thing is just so consolidated on its daily. I mean, look at that. I'm gonna be honest with you. In my whole trading career, I've never seen the stock indices trade like this. Like this is, you got to go way past before even Larry Williams started trading before you can see this kind of stuff. So right away, you can see these lows here and these lows here. Again, this is a March contract, so that way don't get too crazy about it. But I think that this is where we're going to draw to, and then these down here. So we have a couple hundred handles as a downside objective. If we get down to these levels, it could get real interesting. In other words, we could start seeing accelerations that go way beyond these levels here. But I'm trying to refrain from talking like that right now, because I don't want to seem like I'm hyping the move up, because I'm not. I've been rather consistent about my expectations. I'm looking for lower prices. That doesn't mean I can't scalp longs intraday. It just means that I prefer, if I see a setup that's forming for a bearish run lower, I prefer to take that setup over something that would be maybe short-lived on the upside as a little buy opportunity. I let a lot of those things go, because my focus is primarily on this context, this idea, this narrative that I think it's likely to draw lower. All right, so we basically eroded all over these wicks here on a daily. There's a small little volume imbalance there. That, I think, is going to be Monday, Tuesday noteworthy. So have that on your charts. They may use that to trade into it and then become inversion fair value gap, because if you look at it, it's close here, open higher. So it's a bullish delivery of price that creates that volume imbalance. So if it trades below it, what would it be doing? It would act as the opposite. So what would be normally expected to see it trade down to it and then become a reason to go higher, if we go below it and trade back up into the lower half of it and keep the upper half clean without having any bodies laid inside of that portion of it, it would act as a means to see prices, use it as a means of allowing price to go lower. So it should be a formidable resistance if we trade down below it and come back up and keep the midpoint or consequent encroachment in control of price action. All right, so that's the skinny there. Dow, I'm not going to talk about, because you know how I feel about it. I just think that it's, you know, it's a gamble. I don't like that indice, but these are the two indices I like. These are the two indices that if I have a trade idea that I like, I will put real money behind it, because these markets I trust. I don't trust the Dow. The Dow can be overzealous one way or the other, and many times it can just sit sideways while the other ones, NASDAQ and ES, can move around freely. So 30 stocks are not enough for me to take the trust, because it just takes one company rather, to really manipulate that entire indice. Whereas in NASDAQ, it's 100 stocks, and then in the S&P you have 500 of them. So you still see that weight of like things like Nvidia and Meta, those big stocks like that. They have a lot of tug of war effect on the indices, but um, not to the degree that one large company in the Dow list that makes up its indice or average. Uh, that weight is a little bit too exaggerated. And in fact, I mean, I really wish they would do away with the Dow industry average. I think it's archaic now. We don't need it. Or create another indice. You know, maybe fortify it with a little bit more companies, not just use just 30. Okay, everything else is updating and becoming much more efficient, and adding more companies to the stock index average for Dow, I think would be helpful. Maybe do something like 200 or 250 of them, like half the size of weighting that is used for the 500 companies that's used for ES. So we would have like NASDAQ 100 and then 250 for Dow and then 500 for ES. I think that would be a better um, measurement of market breadth across something like that than set something so little in terms of weight, like 30 companies, and people look at that like it's enough. To me, it's not enough, but you know, you teach their own. So anyway, that's what I'm looking for those averages at lower prices, those specific price levels. And then now let's take a quick look at the dollar index because it's already getting a little bit longer in the video than I wanted it to be. Okay. And over here, you'll see this high here. I think because of the war stuff that's going on, I think of the risk off scenario. If we start to see indices slide lower, that'll really add fuel to this wanting to get up into this area and take out these relative equal highs there, and then eventually challenging this high here. I think that this area here has already proven itself, but with that by that run right here and then sending it higher. So where we are at right at this moment, I would use this. Both have a suspension block at the end. I'm sorry, it has a volume imbalance, which makes it a suspension block. It's a buy side imbalance, sell side efficiency, key array, but it has a volume imbalance at the bottom where the bodies don't touch, and the bodies don't touch there. You'll see a small little separation between the two. See that right there? So with that, that makes this a suspension block. And I had the wrong color, got to change that. So this would just simply be a classic buy side imbalance, sell side efficiency type characteristic. We would want to see it trade, if it's going to trade at all, down into this and stay out of that lower half with the bodies. So the bodies would look better not being down in the lower half of that inefficiency. So any retracement body-wise is permitted to get into the lighter area, not in the darker area. Okay, so that would be a perfect um, discount sensitivity display. Leaving a small portion down here open would be wonderful, and then send it higher. And that would put weight on euro dollar and pound dollar. All right, so that's that on the dollar index. If it were to trade, this is where I'm wrong. If we trade below this low here, everything I'm saying here goes to the wayside, and we have to wait for more information. And I will just have to consign myself to, okay, I'm wrong, and I'll have to wait for more information. But because of the war stuff, that's going to be very inspirational for a higher dollar. Now you can argue and say all kinds of things about, you know, we're still presently under de-dollaration and it's not going to have the effect on this, that, and the other thing. Until proven otherwise, folks, I'm just going to go with the classic scenario of this is what usually happens. Okay, um, I can be wrong. It's okay, but these are the things I'm considering when I'm doing my own commentary. When I share my views on what I think the market's going to do, this is what I'm utilizing. As you can see, I'm not ringing in everything that's in my repertoire. I'm keeping it very, very simple. But if it takes out rather on a closing basis this low here, this one here, if it takes that out, then I'm probably wrong, and we're probably going to consolidate more, and then I don't know what we're going to do. I'm not expecting to see lower prices because we have enough in here to warrant that this low has been taken, and it's more in inspiring to me to see prices going higher because of the risk off scenario. Risk off means assets like foreign currency, stock indices, stocks themselves, okay, they're likely to go lower and dollar, go higher. The one consideration that I'm having, and I think we'll hold this point until the end if I have a little bit more time left. I don't know if I'm going to have enough time because I'm going too much as it is commodities. If you look at commodities, some of like the grains, they and with crude oil, which we'll look at in a moment, they're going higher. So when they go higher, it's very difficult for dollar index to go higher. So we're in that little sweet spot of what may or may not happen. We could have a short-lived period where dollar index does in fact trade with crude oil because markets are perfectly in sync all the time, and we're all actively all around the world globally are all weighing the effects of what's going on with Iran and Israel and the U.S. and how it's branching out in other countries. So that weight and that uncertainty is going to be perceived with different weight and significance based on who the party is looking at it. And some of these entities may view it as problematic, while others view it as wonderful criteria to trade in to help them profit from it. So it's a very complex thing, but I'm siding with the idea that we'll probably try to trade up above these highs and clear that eventually. Does that mean that we have to see crude oil be its own animal for a little while and just see it go higher because of the effects of the supply and demand factors that are real with the global demand for oil? Because now all the Middle Eastern countries are turning off their drill. They don't have a way of moving that oil out like when we had in the COVID stuff, where crude oil went negative $40 because we just can't turn off the drills. It takes a great deal of, well, there's a lot of things going on that have to turn those things off. They're not like our spigot or faucet in the kitchen or bathroom. We can turn the water on, turn the water off. It doesn't work that way. Okay, so they have to plan these things in advance because if they know they're not going to be able to move that much oil out, they don't want to be pumping it out. So that's what's going on right now. The countries are turning off and they're saying, okay, we're just going to stop. Producing and you know pulling the oil out. So if that happens, that's obviously going to create a shorter supply and it's going to make a greater demand. And the things that we're seeing in the dollar index may not be germane with that in and of itself. It could be just simply crude oil just goes straight up because there isn't enough supply to meet the demand. And we've already captured Venezuela's crude oil. And I've read the comments, people trying to say, well, you don't know what you're talking about because the crude oil that comes out of Middle East is much more refined. Listen, when we're talking about the global demand for it, we're not talking about, you know, highest test gasoline versus low grade 87 or 80. It- people need it, they're going to buy it, and they're going to get it wherever you can get it. And we're not arguing semantics when it's something like this. This is a big world demand commodity. People need it, companies need it, economies need it. So what I'm saying in short is that crude oil could just simply go vertical higher, and all the other factors may in and of itself be decoupled. So we can't just weight everything on the basis of there's a war, there's a shortage of supply, and the demand's going to go through the roof. So therefore, everything has to collapse because of that. Because that's not what I'm saying here, and I don't think that it at the moment is what's happening. So there's a lot of different things we can do in other markets until we see if this thing goes longer. And they're already saying it may last until September. So, which means if it's going to go to September, we're going to be doing the same stuff over there in 2027. Okay, so I'm not looking for a quick end at all this stuff. They want a bigger, broader thing over there, and I think that's what we're building a theater for that. I'm not in support of either side. I wish it wasn't going on, but it is what it is. As a trader, as a speculator, as an analyst, as an educator, talking about these things in commentary, I have to make them aware to you So that way you consider them, because if you're not at least considering them, you can be broadsided by events that would otherwise not be so shocking or jarring if you aren't looking at it. Okay, because you can might say, I don't trade crude oil, so this doesn't make any difference to me. Eventually, what's going on over there is going to reverberate into other markets. So let's go into crude oil real quick. We'll pull up the continuous contract. All right, and this we'll pull out a weekly chart real quick, and I'll show you historical highs. I think we're going through that. Okay, so that way you know this right here is going to give up the ghost. I think we'll be higher than that. Initially, I think 140, 150, and if we get above 150, it might accelerate in the 200s. We have had a run very close to this high here. That's the next one right there. We're in close proximity. So I wouldn't be surprised if we open above that or very close to it and then run to it. And then in near, we don't really have any inefficiencies. It's noteworthy until we get up into this area right in here. So that would be one that you want to have on your chart. Include the volume imbalance at the high and the low. So have that on your chart. You can see the price level axis over here, what those levels are. I'm not going to extend it over.